So first of all, let me start with a thank you. Thank you for so many of you joining today's webinar. As I hope is clear from the invite, the purpose of this webinar is to address a very specific question from the Symbiosis RFP, which is specifically on guaranteed delivery. And it's to help those who want to make a submission to respond to that element of the RFP. Of course, it contains many other things, but that's what this is focused on. And as I'm sure many of you know, otherwise you wouldn't be here, this RFP is pretty significant for the VCM, not just because of its scale, 20 million tons is a lot, but it's got a good focus, not just on quality that everybody would have, but also on the ability to execute, which is particularly in this case about how do you manage delivery risk and how do you give guarantees of that. And the RFP outlines a range of delivery risk mitigation approaches for people to use, many of which have been used for many years. People who've been in the market will know this. It's been pretty standard for people to do sort of haircuts and buffers internally in order to give themselves a bit of wiggle room, even though that creates some inefficiency. And many will be used to putting in clauses in their contracts to try and mitigate some of those risks or push the risk onto others. But it's also identified, I think, for one of the first times of such a significant RFP, as is identified insurance as an approach that it will consider. And given this is a relatively new development to have insurance in the VCM, many of us have wanted it for many years, but now it's here, we thought it's helpful to explore this option and compare and contrast it with the other options that we've got. So that's what we're going to try and do today. And let me just do some quick introductions. For those who don't know me, no reason to assume you do, I'm Vaughan Lindsay. I was the former CEO of Climate Impact Partners, and I've been asked to moderate today's discussion. So that's me. But more importantly, we have three fantastic experts in the VCM who can help provide differing perspectives on how you go about managing delivery risk mitigation. We've got Rob Lee from Katona Climate. Rob is the Chief Carbon Officer and co-CEO at Katona, and has been a respected thought leader for many, many years. And Rob can help provide a perspective from an experienced investor and partner to the on-the-ground partner developers. We've also got Elizabeth Yandel McNeil, who is a partner at K&L Gates with a focus on renewable energy and carbon removal transactions. And Elizabeth can provide real expertise on the contracting options when addressing requests for guaranteed delivery. So thank you, Elizabeth, for joining. And then we have Nandini Wilkie, who is a co-founder of Carbon Pool and also by background a lawyer and deep into insurance. And Nandini can provide an overview of how in-kind insurance can be used to meet delivery risk guarantees. So that's who we've got as our panel. This session is only scheduled for 45 minutes, so we'll be reasonably quick and to the point. In a moment, I'll ask each panelist to provide a quick overview from their perspective on how best to manage guaranteed delivery requests. And then we'll open it up for questions. And thank you for those who've already sent questions in advance. That was extremely helpful. But I thought we'd start off, if we could, with a quick overview of in-kind insurance, because and Nandi, I hope you don't mind doing this, because I think it's worth making sure everybody understands what in-kind insurance is, because it's relatively new for the VCM. And I thought maybe we could start with that, and then we'll go and get the perspectives of each panel member. So can I hand over to you, Nandini, to give a quick overview?
Yes, absolutely. Thank you very much, Vaughan, and thank you everyone for being here today. In my remarks, I'm just going to focus on the product that we are developing at Carbon Pool that feels the most relevant. There are clearly a number of insurance options that have emerged in the VCM in the last couple of years. But one of the reasons that we wanted to convene this discussion today is because, as Vaughan mentioned in his introductory remarks, the Symbiosis Coalition RFP does ask developers to comment on how they intend to mitigate their delivery risk, considering that they need to guarantee a minimum number of tons. And they mention a number of different possibilities, which my co-panelists will speak to. And one of the possibilities they talk about is including carbon insurance. As a co-founder of Carbon Pool, which we are seeking to be the world's first regulated, that means with an insurance license from the insurance regulator in Switzerland, to offer insurance that is in kind. And what does that mean? And again, I'm going to try really hard to hone in on what does it mean for the people on this call who may be responding to the RFP and thinking to themselves, okay, how is this insurance thing actually going to help me mitigate my delivery risk? I'm going to talk to you about our key product. We call it our shortfall insurance. It could also be called under-delivery insurance. Same thing. How does our shortfall insurance product work? We've prepared a little overview for you here just because it's a lot of terms. And I wanted to make sure that some people are, like to have a visual aid. That's why we've prepared this slide. We will also share something after the call for people who are interested. But how does our product work? The way that our product works is that you enter a developer of an afforestation project will enter into a contract with us, and the term of that insurance contract can be as long as 5 years. It depends on what your credit issuance cycle is. So if your credit issuance cycle is 3 years, or if it's 2 years, or if it's 4 years, we can accommodate that. The maximum we can accommodate is 5 years. So what does that mean? It means that, let's say that in 2025, you bring to Carbon Pool your afforestation project, and you ask us to do a risk assessment. We do that. We agree upon on an insurance price, and you would like to enter into that contract with us. The way it would work is that you pay us an insurance premium today in cash, not in credits, but in cash. We take that cash together with some of our own capital, and we invest it into carbon credits. And at your next, whatever the term of the insurance contract is, which again is the same as your issuance cycle, at the end, so let's say it's 5 years, you will go out and do your MRV report, as you would anyway, to get your credits issued. And let's imagine that in our contract, we've agreed that you are insuring 100,000 tons of CO2 removed. Let's say that your MRV report shows that, in fact, you've only got 70,000. And the reason for that is a natural reason. It's that the trees didn't grow as expected because there was too much rain, or there was a fire, or there was a drought, or there was a disease infestation. Whatever the reason, that reason is, it is a reason that needs to be one of the risks that are covered by the policy, which you see in the bottom left of the screen here. We would pay you the difference. So whatever the difference is between the 100,000 tons that you insured and whatever you actually produced, we would pay that to you in kind. What does in kind mean? It means I will pay you with carbon removal credits that are from nature-based solutions. And in terms of the quality of those credits, people ask me, are they the same as the ones that I lost? They will be similar in characteristics. So they will be have a high rating from the ratings agencies. They will be CCP aligned. They will come from an ICROA registry, and they will have gone through our own insurance, our carbon risk modeling. Will they be exactly the same? No, because if they were the same, they would have been at risk too. But that is the essence of how our policy works. So I think I'll stop there, Vaughn.
That's very helpful. Yeah, no, it's very helpful. And I think it's worth spending a bit of time because it is a new thing to the sector, and I just want to make sure that people are, we're level set and everybody has the same view, or the same understanding of it anyway. So thank you for that, Nandini. I'm going to open up the initial questions to the panelists now. And I wanted to start with you, Rob, if I could. And Rob, you're an experienced partner for project developers. And tell me, how do you consider meeting the requirements for guaranteed delivery?
Yeah, thanks, Vaughn. Appreciate the opportunity to be speaking on this panel today. As mentioned, I'm the co-CEO of Katona Climate. Just to do a quick intro, we're a mission-driven carbon solutions company. We really specialize in early-stage carbon project investment and aiming to fill the critical financing gaps during the highest risk phases of project development. We also partner with companies to explore creative methods for distribution of carbon credits. And before I continue, just be remiss if I didn't plug we are open for business. If there's any project developers on the webinar today looking for financing or looking for a partner to collaborate on their submissions, please feel free to reach out. But specifically to your question, the way that we approach risk mitigation historically is it's multi-layered, right? So the first line of defense is really grounded in sound, active, kind of technical and operational project management, right? Making sure that your project operations are as efficient as possible and running smoothly. So that could be things like if we'll use the reforestation example, that would be, in the early stages, making sure that your carbon projections that you're using to underwrite the project are properly calibrated to the local conditions, using specific tree species, the specific planting techniques that you're going to be implementing, rather than trying to rely on more generic growth curves or survival rates or things like that. And then on the operational side, this would be, making sure that you have operational controls to cover project execution risks. So again, using the reforestation example, this would be things like making sure that you have sound processes for all of your, supply chains. So making sure that you have seed sourcing, seedling supply, nursery operations all buttoned up, planting technique training, inventory field manuals for how you do your carbon measurements, things like that. And then ongoing monitoring and evaluation of how your project's performing over time. These are, I think, pretty fundamental risk management tools. That's really going towards making sure that you have line of sight and operational control over the project outcome. But as Nandini mentioned, even if you're operationally perfect, there are things that are out of your control that can still lead to under-deliveries. That's what we would call kind of our first line of defense and risk management or mitigation. The second line of defense would be, I think, broadly categorized as maybe inventory management or portfolio management tactics. These are kind of, I would say, blunt and inelegant methods, but I'm sure every carbon developer who's been in the business of forward offtake or forward contracting has done some flavor of this, where it's deliberate holdbacks of inventory, haircutting your own inventory that's available for forward sale, trying to cross-collateralize one project as a backstop to another project, offering replacement credits from other projects in your portfolio if you're not able to fulfill a forward delivery from another project, or even like replace an obligation to source replacement credits on your own dime if you haven't delivered the full volume that you've contracted. These are all tactics that I think can be effective, but they're relatively inefficient, I would say. You're facing pretty big trade-offs in terms of being able to maximize your own revenue with fairly limited information. And managing risk this way is really ultimately going to bear cost on your firm because you're not able to sell inventory that you want to be selling. You're holding it on your books and trying to manage internal risk without really, having the appropriate professionals in-house, I would say. I don't know of any carbon developers that are that have maybe like a insurance actuary on hand to be measuring what these risks actually are. So yeah, I think it's quite a challenging problem. I'm personally, and our firm is really excited about exploring some of the new innovations in the carbon insurance space. So yeah, thanks for having me, and maybe I'll stop.
No, that's super helpful, Rob, and thanks for that. And certainly, your first line of defense is sort of, be a good project developer. So let's assume everybody is a good project developer, does all the right things. The thing I've always struggled with this sort of haircutting is that it happens at every layer. So you end up getting, you get escalating inefficiencies. So as the developer, you'll take a haircut because you want to be safe. The intermediary who may be working with you will also take a haircut because they can't be sure that you've done it correctly. And then the buyer takes a haircut as well. So you end up getting a hugely inefficient system where everybody's trying to cover their risk individually. While, of course, from my experience in the insurance sector, of course, you're pooling it. So therefore, it's much more efficient. So I don't know whether you share that view or whether I'm just out on a limb on that, but I always think this continual haircutting is quite an inefficient way of the market operating.
No, that's absolutely true. And even it goes even further to, early stage development where you're haircutting your carbon curves as well.
Yeah.
So every layer of the development process and the transaction is further cutting the carving value out.
Yeah, for sure. And Elizabeth, okay, if I can move over to you from a sort of contracting perspective, you would have wrestled with this, huge amounts of times where people are trying to give some guarantees and they're trying to find the best way to do that without exposing themselves to too much risk or trying to lay it off onto other things. What would be your approach and advice to helping manage requests for guaranteed delivery?
Yeah, thank you. So when you're dealing with contractual provisions around risk mitigation, it's really just piggybacking on the commercial issues and making sure that all of the terms that are agreed from a commercial perspective are correctly reflected in the agreement, because obviously if it's not in the agreement, you can't rely on it later. So it's key to make sure that every piece of the understanding is in the agreement in the first place. And then as another initial matter, as Rob walked us through, developers really do need to think about the schedule and volume that they put in the contract, make sure there's room to meet that. Yeah, that leads to sort of haircuts and concerns, but also once a schedule is in the contract, it's sort of set in stone. And so then if there need to be changes made to that aren't anticipated in the contract, then at minimum, it's an amendment to the contract where the parties have to negotiate and figure it out. Or, worse, it triggers defaults or penalties. And so that's a really key piece to keep in mind, both from a, operational standpoint, but also from a contractual standpoint. Then for anticipating causes of delay, I think is an important thing where, it may be agreeable to the parties to say, provide for an automatic delay in delivery obligations or something along those lines based on a registry related delay that the parties hadn't anticipated or something like that. On the flip side of that, developers are going to want the flexibility, but off-takers are going to want assurances that they're going to be getting their deliveries on time. So that's another piece. And then for remedies in the event of delivery shortfall, we've talked about providing replacement CRUs. Whenever a developer is dealing with CRUs other than project CRUs from the agreed project, of course, there's going to be preferences from the off-taker about what a replacement CRU is going to look like, and different off-takers are going to have different preferences. So that's something that the parties need to figure out in advance. And then also, developers are going to want to balance wanting to provide replacement CRUs with their ability to do so realistically. As we've been talking about, it can be hard to find replacements. So if a developer has a lot of different similar projects, maybe that's going to be an easier thing to agree to. Or if it's a smaller developer or there's a wide variety of projects, then maybe replacement CRUs are going to be harder to find. And then, of course, money damages are an option, and that's often less favored by developers and by off-takers because off-takers are trying to buy credits in the first place, so money damages doesn't get them where they want to be. And oftentimes developers, if they're experiencing shortfalls, there may be other challenges going on that means that paying monetary damages is not as feasible. So we've been talking about insurance as well, and as Nandina mentioned, this provides credits instead of money. And it also has a third party who's standing behind these obligations, so that it may provide the off-taker with some assurances that they're going to have somebody that they can recover from, versus having to try to be collecting against a developer who, again, is experiencing some shortfall issues. I think something to keep in mind, too, is that developers are going to need to make sure, if they're dealing with this insurance option, that the off-taker is going to be comfortable with what's being provided. And then also, obviously, there's going to be an additional cost to that. So those are the things I think to keep in mind. And then when we're looking at remedies, I think we can look at any of these remedies separately, but you can also do sort of a collection of remedies as an option, and you can really customize that for what the developer and the off-taker want to see. or a waterfall where first replacement CRUs, for example, and then if that's not available, you can look to insurance or you can look to monetary damages or put them together however you want. The downside to that is that the timeline for this replacement, for this shortfall delivery or delivery shortfall, is going to be extended to allow for time to meet all of the various possibilities for curing the shortfall. So those are the things that I keep in mind when I'm looking at contractual provisions.
Well, that's helpful. And a very interesting question just come up on the chat about community engagement and community benefits. So a lot of projects, a lot of the value is some of their co-benefits, and increasingly, quite rightly so, important to have community engagement and buy-in. And that can take time and that can slow things down. So you quite rightly said, we all used to worry about the registries changing the rules and slowing stuff down, but sometimes community engagement has to take its pace, and that is slower than you thought. Have you had any experience about how you sort of factor that into contracting clauses?
Yeah, so at any time when you have a developer and an off-taker, there are going to be different priorities because of what the developer is offering or what the off-taker is looking for specifically. And so with community engagement, there's going to be perhaps on the off-taker's side a little bit more flexibility in dealing with delays or other things in exchange for having this element of community engagement or the sort of other pieces of the project that are important to the off-taker. So it's the contract is going to be adapted according to what the priorities of both parties are. And so the flexibility in the terms of the contract is going to reflect those priorities of the parties.
And one other sort of, you may say I'm too much of a cynic from the market, but there is one of the, it may just be my experience, but one of the things about using the contract to mitigate these risks is it can massively extend doing the deal. You can sort of do the deal and then you can spend up to 6 months negotiating the detailed terms of these things, which of course is a big drain on the developers and actually makes it very sticky process. So because you can put lots of these clauses, and then there's also the concern from the buyer side where they see these things as paper tigers, which is, yeah, you put them in, but you're never going to be able to keep some of these things because how will you deliver some of these things? Given those sort of concerns that it sort of slows the process down, and sometimes the buyers look at these, even when they get the clauses they want, they look at them as sort of, are they really real? How do you view insurance as an ability to both speed up the process and give more assurance to the buyers who really just want to make sure that the right number of credits are delivered at the right time to meet whatever their net zero or claim commitments are?
I mean, I think in any context, the further the parties are apart, the longer the contract is going to take. So if you have two parties that are just agreeing, okay, well, we're just going to have this many credits, it's going to be an 80% delivery threshold. And then if it's below 80%, we're going to have to make up the difference with shortfall remedies. The shortfall remedies are going to be replacement CRUs followed by drawing on insurance, and it's going to be a 10-year term. That takes minutes, in the scheme of things. And so to the extent that insurance offers something that both of the parties can agree on from the first place and doesn't, they don't need to argue about it as they're negotiating their contract, well, yeah, it's gonna speed up the process. But any sort of prolonged process in the contracting is often a result of the distance between the parties and what they're able or willing to agree to versus the process of the contract itself.
Good. No, thank you, Elizabeth. So Nandini, coming back to you. So interested in see what you see, well, for you to explain to everybody the value of insurance, because Rob's outlined pretty sophisticated ways that people have got used to managing projects and trying to manage those risks. Elizabeth has outlined a sort of waterfall approach you can use within your contract. Those all seem to sort of work. So what's the additional value that insurance offers?
It's a good question, but I think it's, in a way, it's the topic that you mentioned at the beginning, which is this notion that people are maintaining buffers in order to be able to meet delivery requirements at various levels. And collectively, those buffers are restricting available supply in the market, they're driving up prices, and they're delaying financially for a developer, they're delaying the returns. It's true that ultimately you may be able to sell whatever credits are left over, but ultimately it's delaying that cash flow, and that's an effect that your investors also experience, right? The cash flow that they could be getting up front is now delayed, which affects their IRR. I mean, but generally speaking, I think that there are a couple of important points about what insurance can add here. I think the first thing is we are all trying as hard as we can to professionalize the voluntary carbon market, right? And insurance is a way to do that. In every mature market in the world, there's insurance, right? Shipping or construction or logistics or, car insurance, health insurance, in every meaningful industry, in every meaningful market in the world, there is insurance. And there's a reason for that, right? It's because insurance provides that centralized risk-bearing capacity. So it's much more efficient. Second of all, insurance prices risk, right? And that's a really important signal for people who are investing into a market. It's a quantitative process. So when we do our risk modeling, we do 100,000 simulations and we come up with a curve, and that we assign a price and a probability to the delivery of the carbon sequestration benefits and how they might be affected by weather. That is a really, really important signal. And it's a signal, it's a non-biased signal of quality, if you want. And it's important in lots of markets. It goes back to the topic of reputation and integrity, right? It's not me just giving you my opinion. It's a machine that spits out a number, right? So in that sense, I think it's a very useful metric. I think the other really important point is that some of the remedies that Elizabeth mentioned, which are, you maintain a buffer or you agree that you will source credits from another project. If you maintain a buffer, you don't know if it's going to be enough, right? That's why you don't self-insure for your health, or you don't self-insure because you just don't know whether what you are maintaining is going to be too little or too much. If you're lucky, great, it's too much, and at the end of the project's life, you can sell a bunch of credits. If you're unlucky and there's a catastrophe, and people like to think they can self-insure until something goes terribly wrong, and then they wish they'd had insurance, right? I mean, right now with the wildfires in California, and I say this with the most sensitivity and respect and empathy for the people who are suffering through this crisis, as they are all over the world. I mean, California just happens to be going on right now and is therefore at the forefront of my mind. And lots of people there don't have insurance on their homes because those areas are so risky that insurance companies don't insure there anymore. So it's a really important risk and price, and a risk and price signal. And if you don't have insurance, then you have to replace something that's extremely expensive, which you may not have the financial wherewithal to replace. So I think insurance is really important to professionalize this market, and it adds a lot of benefits and comfort for the developer too. I mean, all of these developers who are pouring their hearts and souls into designing these amazing projects, they're putting their reputations at stake, right? You're putting your credibility at stake when you enter into an offtake agreement and you say, I'm going to deliver. What happens if your buffer is not large enough, right? What happens if you suffer an unforeseen catastrophe? You're going to wish that you had protection, and the protection that we offer is monitored by a regulator. Somebody's making sure that I have enough credits to be able to pay you. And I think that is, to me, that's like really the fundamental point here, which is that in order for the voluntary carbon market to become really professional and for the integrity to get better and better, people have to know that they're going to get what they bargained for when they enter into an offtake agreement. I also just wanted to pick up on the point that Rob made. Rob talked a lot about the incredible efforts that Katona goes to ensure that the project is well set up to implement its goals. And people do ask me sometimes, can you ensure the project developer, making mistakes? The answer is, generally speaking, I can't really ensure that. I mean, I suppose, but it would be incredibly expensive. The way to deal with that, though, is to be really rigorous in how you set up your project. I know that's easier said than done. And it sounds like Rob would be a good person to talk to about how to do that well. And I think there are resources out there, and there need to be more resources out there. I know that there is, for example, an accelerator for carbon credit project developers out there to help them do this well. But there are some risks that you need to manage through due diligence and through, correct project operation. And there are some risks, the catastrophic risks, that are best managed via insurance.
Yeah, and I think that's well put. I think there are things that are about efficiently running your project and making sure you have, stage gates and milestones and stuff in your contracts. That can manage some of it, but it can't manage the black swan events that nobody thought would happen.
Right.
And that's why, I assume insurance survives and continues to thrive in every other sector, because pooling risk is better than taking it on yourself. Right. So it's clearly going to be a more efficient thing. And can you say a little bit about the in-kind side? Because one of the things, of course, which is distinctive is, most people are used to insurance and you get a payout and you get some cash and you go out and buy a replacement. But in your case, you're going to pay in-kind credits. And you mentioned some of it about your introductions, but there will be a lot of people who will be, well, how do we know you're going to give us stuff that's going to be of comparable quality with the same co-benefits that we've talked to the buyers about and all those sorts of things? Tell us a little bit about how you ensure that.
Right. It's a great question. It's a question I get all the time. I mean, I can tell you off the bat that Carbon Pool is investing its own capital in carbon removal credits. I have a very, very strong alignment of interest with you, the insured party, that I get it right. So, because if I invest money in credits that are not good credits, then I won't have enough credits to pay my claims, and I will have a very big problem with my regulator, right? So first, just off the bat, that is, you don't usually have that insurance, right? Usually insurance companies pay in cash, right? So there's no alignment of interest point that is relevant there. Second of all, will I be able to guarantee the same co-benefits? No, but remember, you're not buying your credits from me, right? Your buyers are not buying credits from me. I'm just your worst case solution. And I guess what I like to ask buyers is, if you're making a net zero claim and your developer isn't able to deliver the tons that you are counting on to make that net zero claim, would you like cash from me or would you like credits? And each time they've said, well, I mean, I can't deploy the cash really in good quality credits. That's the reason we pay in credits, is because it's difficult. It takes a long time to be able to find good quality removals and transact. And I have a team of people who do nothing but that all day long. They source, they do diligence, they contract, right? And that's the key benefit. Now, having said all of that, I recognize that buyers will have a question about that, and they'll say, "Oh, I don't know. I signed up to buy credits from Katona. I didn't sign up to buy credits from Carbon Pool." Right. That is correct. And I will just say, we are very happy to have conversations with people about this, to do what we can to get people comfortable. We are very, we're open. We totally see that this is, people are concerned about this, and I understand that, and we're happy to talk with them about it. But I can't promise to give you exactly what you lost, because if I were investing in what you lost, then I would have lost it too.
For sure. Now we're getting a ton of questions, and I've been reminded we've only got 10 minutes left. So my sense is the answer to this question about responding to requests for guarantees, it's not either or, it's both and. You should do good project management, good disciplines. Where you should contract manageable things into your contract. But for things that you can't manage or outside of your control, insurance provides the cover that gives you that sort of certainty. What we're getting in the questions, which is going to be my next question, so somebody in the audience has the same thinking as me, which is about price. So there was a question here about how are the insurance premiums calculated by Carbon Pool. So I say that because when I was active in the carbon markets, we always wished we had insurance. But whenever we talked about it, they priced it so crazily because they didn't really understand the market. So to cover themselves, they put premiums so high that we just end up thinking, oh, it's better off just self-insuring because the price is so crazy. So can you just say a little bit about how you calculate the premiums and give people a sense of what those premium levels are likely to be? I know that's a $1 million question, but I'll put you on the spot.
Yeah, no, I'm happy to do that. Without getting into a super boring technical explanation, one of the reasons we're paying in kind is precisely because if you're a standard insurance company and you are taking the market price risk that the price of carbon credits fluctuates and goes up, then it becomes very expensive to the insurance company. That's why the premiums have been so high historically. That's why we're building a carbon balance sheet. The way the price is calculated is simply a reflection of two things, really. It's what we call the risk cost. So we do the simulation. We also add some of the capital costs that it costs us to be able to have this risk on in our portfolio. And then we also figure in what is it going to cost us to replace this credit. So we figure in a per credit replacement price. And that's how we come up with the price. And so far, I mean, we've modeled probably over 100 projects at this point, and the prices we come out with are somewhere between, I would say, $3 and $4 paid one time upfront per credit. So if that's a 5-year cover, that's 80 cents per credit per year, right? But you pay it upfront. So you pay for the 5 years. So you pay the $4 once upfront. I take the money, I invest it in credits. I have it to pay you if something goes wrong.
And there's a specific, I'm sorry to keep bombarding you, Nandini, but it's a new thing, and there's a lot of questions coming up. So there's a question here, which is, can a buyer refuse the replacement credits offered and rather than seek a sort of inflation-adjusted payout instead?
I saw that question in the chat, and I think I actually wanted to answer. I think it's a very good question. Look, I speak under the direction of my chief investment officer. I do not see why the way the policy would work is that we would insure a sum of credits. But if at the end the buyer says, I don't want the credits you're giving me, can you sell the credits you would have paid me and give me whatever the cash you get from it is? I think that is possible. It's not ideal. That's not my core business model. But is it something that we could consider? I believe so. So I would invite whoever wrote that question to reach out to us, and we will absolutely talk about it with you. As long as it works for us from a sort of being able to execute point of view, because as an insurer, we really have to be able to execute.
For sure. And then maybe if I can go back to a question to Rob and Elizabeth. There is a question here about, how should developers balance between hedging delivery risk, i.e. sort of underselling or giving a buffer, whilst trying to keep the prices acceptably low or competitive. So there's a sort of balance between, giving yourself enough buffer so you're certain, but if you do that, of course, as Nandini has mentioned, it just pushes the price up. So how do you sort of begin to balance those two things? And I'll start with you, Rob, if I can, because you'll be at the sharp end of that with a lot of the work that you do.
Yeah, I would say, for that question, maybe I might push back and say, what does it mean to keep the price low? If it's artificially low, that's not healthy for the market. And so what we need to be doing is really understanding what the actual price to develop these projects is, what the price to, in terms of offtake or demand, it needs to be to actually support the development costs as well as underwriting all the risks. So I would say I don't feel like there's need from the supplier side to try to keep prices low. It's what do you actually need to support an actual business that's viable? And if the demand for that price isn't there, then that's a fundamentally unhealthy market. And we need to fix that. So yeah, I think maybe that's where I would lean is understand what your actual costs of developing the projects are and what the risk mitigation tools are that you need to include in that cost are. And if you're not able to command the price that you need to command, that's something to be dealt with. Maybe that's maybe that's you need to, maybe work with a group like a Katona to help you market a little bit better, or, I think that, yeah, I would push back on the question a
No,
little
it's a
bit.
fair pushback, and many would say the price has been artificially too low for too many years already. So it's a fair point. Elizabeth, do you sort of see that sort of balance where people are trying to sort of give a bit of guarantee, but also trying to be, as attractive and as commercial as possible?
Yeah, I'm gonna join Robin in the pushback in that I think the price and the terms are really up to what the priorities of the parties are. So the parties might agree to more wiggle room on delays or timelines if other attributes of a particular project are important to them, or as we were talking about earlier, community engagement or other things like that. And there may be more of an appetite for an off-taker to pay a higher price for what they view as a better project. So I think that ultimately what it comes down to is what are the parties, what do the parties value? What are their priorities? And then reflecting that in the contract is, once that's determined, just writing the contract, that's the easy part.
Very good. No, quite right. We're coming to the end of our time. I'm conscious we're good. And just to let you know, we haven't been able to address all the questions. We will answer those and send those out in the materials we send out after this webinar. So if we haven't been able to answer questions, I apologize, but we will give you an answer. So I'm going to try in the last couple of minutes, we'll lead question not to you, Nandini, because I know what your answer will be, but it's to Rob and to Elizabeth, which is, do you see the role of insurance in helping manage some of these challenges? Is it something you think, yep, we've been waiting for years for this, and this is a great thing to have in addition to some of the things we do already? Or are you still quizzical about it? I shall start with you, Rob, and then go on to you, Elizabeth, to give you a little bit of time to think.
Yeah, I mean, I think hopefully my presence on the webinar here suggests what the answer is to that. But yeah, absolutely. Just going back to Nandini's answers on pricing of the premiums, the delta between the carbon pool premium and what we're selling our credits at on an offtake basis are significant. And by being able to leverage insurance products that are efficient and cost efficient, we're able to really maximize our own returns. And I think that's really important.
For sure. Elizabeth, final word to you.
Yeah, thanks. I think that it's really important to have to have a good, solid contract that makes sure that it reflects what the parties agree, because it protects both parties. But I think it's really a great opportunity to be able to think about insurance as a part of the toolkit that can respond to shortfalls, because it's another opportunity to have credits available when there's a shortfall and not just immediately relying on monetary damages if there's any sort of problem with the actual supply of the credits. So
brilliant. Thank you. Well, in the last one, I just want to say thank you again for our panelists, for Nandini, Rob, and Elizabeth. Thank you for joining. I hope for those who have joined the webinar, it was helpful. They will be sending out some notes afterwards for those that are interested. And in that, if you're interested in finding out more, either from Elizabeth or Rob or Nandini about insurance, there will be ways that you can contact them, or feel free to reach out to them directly if you want to as well. Thank you for your time. We're a little bit over, but I hope that has been helpful, and enjoy the rest of your days. Many thanks.